Hi, by popular demand today, I'm going to go through SPACs and which one I think is the best. SPACs are definitely not for everyone, but I can see their appeal. 2020 was definitely the year of the SPAC with 237 for the year. That is far more than double the amount of 2019. So what is going on here? Should we be looking at these as an investment, and what do I think is the best strategy to take? Now, if you are new here, well, welcome aboard. I'm trying to help as many people as possible understand what they're actually investing in. Look, there's a lot of hype around SPACs at the moment, so I'm trying to get you to understand what's actually happening here so you don't make any mistakes with your money. Now, if you do have an investment you would like me to cover, look, please make sure to tell me some real reasons why it's a potential 100 bagger. So a stock that can go up 100x over the next few decades. So it'll most likely need to be under $1 billion in size right now. Just give me some good reasons. And if I find it really interesting, well, that would be very appreciative, and I'll definitely make a video of it if I love it. Okay, a SPAC is a so-called blank check company. An investor or group of investors, or called sponsors, form a new entity and raise money from the public for an IPO. So the money raised is placed in a trust and it can't be touched by the sponsors until a deal is approved, which is good. So no stealing can happen of that money. Now the people responsible for that money, the sponsors, then have 2 years to find a company to buy, at which point the SPAC investors get to vote for or against that deal. Investors who buy the SPAC at par value have essentially no risk prior to the deal closing, because if they don't like the deal, they can elect to get their money back. So what that means is when investors pay $10 per unit and can get their $10 back if they don't like the deal. So SPACs are usually a low risk investment if you're able to buy them around book value, which is normally as close to $10 as possible. So Charlie Munger a few weeks ago came out and said that the world would be a better place without SPACs. He had a few more bad words to say about SPACs that I can't repeat here, just in case you have kids in the room. And truthfully, SPACs have historically been dreadful investments after the deal has closed, and for good reason. See, unfortunately, the sponsors are actually incentivized to do a deal regardless of whether the deal is attractive to outside shareholders or not. This is because most SPACs are structured in a way that gives a large portion of the equity value, normally about 20% even, directly to the sponsors. These are called founder shares, and this is absolutely free money for the sponsors. So if a sponsor has 2 years to do a deal and has $500 million in cash from the pool of funds in the SPAC IPO, then even if they spend $500 million in cash to buy a business worth $250 million, in other words, they pay the seller twice what the business is actually worth, obviously a huge destruction of value for the SPAC shareholders. And even in this extreme case, the sponsors still walk away with $50 million because 20% of that $250 million of value is $50 million. In other words, the stock might IPO at $10, which is the price most SPACs IPO at, then fall to say $5 once the market weighing machine correctly values the new business, meaning the sponsors have destroyed $250 million in value but still walked away with $50 million in cash when they sell their founder shares at $5 a piece. Even though it went from $10 to $5 and they sell at $5, they still make a big cut. These deals are extremely misaligned at best and look borderline criminal at worst. Now, it's not that all SPAC deals are bad, and of course the sponsor would prefer to get a good deal over a bad deal. But it's just that the incentives are structured in such a way that if a sponsor can't find a good deal, they're probably going to do a bad deal over a no deal. Okay, now I know this sounds extreme, but I've seen numerous SPACs that have performed this poorly or worse. The founder shares basically create a 20% hurdle for us outsider shareholders. That's because that first 20% of any value created goes to the sponsors before outside shareholders see any return on their investment. The first SPACs I'm going to talk about today are the wildly popular Chamath based SPACs, where he has named them IPO A, IPO B, IPO C, IPO D, and so on. Now, generally speaking, I like Chamath, and I wish I could invest alongside him. These SPACs almost give me that opportunity, but like in the above examples, he takes a 20% cut. But what you get with Chamath is his reputation, and that is why I can see people investing in his SPACs. Chamath is a smart guy and someone that I think is going to even be more successful than he currently is. I would bet on Chamath being more successful, but I just don't know about his SPACs. I'm a little concerned they are more of a publicity stunt than anything, but look, his name is attached to these SPACs, therefore so is his reputation. The way I think about these SPACs from Chamath as more of a venture capital play alongside a very smart investor. Some of these companies are going to fail. Some of them are going to be hugely disruptive and successful, but just like the venture capital world, it's quite a gamble. If I was to analyze each of the companies, Virgin Galactic, Open Door, and Clover Health, that were originally IPO A, IPO B, and IPO C, I actually wouldn't invest in any of them, just because I don't know enough about each of their industries and I find cash flow negative companies just really difficult to value. Plus, there is so much hype around these companies, which makes me think I can just focus my attention somewhere else. They're in the too hard basket for me, even though I would like to somehow invest with Chamath. I'll be looking very closely when Chamath's company Social Capital goes public. That will be more interesting. Okay, so Bill Ackman's Herbalife bet was a PR nightmare and his fund's performance suffered for 4 straight years. But then, the fund had an incredible 2019, up around 60%, and he has followed that up with an even better 2020. His perfectly timed hedge against the stock market back in February 2020 was literally the best short trade I have ever heard of. Even without this huge multi-billion-dollar win, his portfolio has performed extremely well and his fund is up about 70% in 2020. Now, he's taken advantage of this turnaround in his reputation as an investor and has capitalized in a big way by raising the largest SPAC in history. Ackman's firm is the sponsor of Pershing Square Tontine Holdings, the SPAC that raised $4 billion from the public. Also, Ackman's funds have agreed to invest a minimum $1 billion more at the same terms as outside shareholders, with an option to invest as much as $3 billion. So the company has a minimum $5 billion to work with and a maximum of $7 billion to work with to buy a company. Ackman has given a number of interviews discussing what he's looking for, but in short, he's looking for the same type of company that he always prefers, which is a quality business with a strong position that generates cash. But for me, what is most interesting is this is no ordinary SPAC, and for a few main reasons. Number one, there are no founder shares, so Ackman and his fund aren't getting any compensation. They did invest $65 million to buy warrants at 6% on the future entity, but those warrants have a strike price of $24. Look, doesn't really matter. The stock has to rise 20% before those warrants are any good, and they will expire worthless if Ackman does a bad deal. And on top of that, he can't even exercise these warrants for 3 years, so his incentives are aligned. Ackman's funds have committed to invest $1 billion, which is a big position for Ackman. His publicly traded fund has around $7 billion of capital. So this is a big chunk. And this investment is in the same shares and on the same terms as IPO investors received. So just like me. So there's no freebies and no special treatment here. Finally, this SPAC is very unique in another way. Now, I have to get really technical here and I apologize. It's a unique feature of this SPAC and it is important. Look, don't even try to understand it exactly, just get a feel for what this means. I'm pulling this info directly from Saber Capital's website, who did a write-up on this. Okay, so when you buy a unit of the SPAC, you get a share of common stock plus 1/9 of a warrant. Now, 1 full warrant for every 9 shares you own. But there is a big twist. Shareholders receive an additional 2/9 of a warrant for each share if they choose to invest in the deal. And they also receive bonus warrants on a pro rata basis from a pool of warrants that are left over for any shareholders that choose to redeem these shares. So if you invest in the deal, you get 3/9 of a warrant plus possibly even more warrants depending on how many people don't want to invest. This is a smart concept because it eliminates one of the drawbacks that a SPAC has for the sponsor, which is you never know as the sponsor if you'll be able to get enough votes to close the deal. And if you come up short, well, Ackman is forced to raise additional financing, which often is further dilutive to the shareholders. So to sum all that up, when you buy a share of this SPAC, you get a company with $20 in cash that you can get back if you choose, plus 1/3 of a warrant, plus potential for additional warrants, plus the upside of Ackman doing a great deal with a high quality company that you might want to invest in. It's not a given for sure, but it's still a nice upside option. Now, if Ackman announces a deal, it's possible that the stock rises dramatically if the market likes the business. And this would give you the option of either holding your shares if you still like the valuation, or selling it into the market if you don't. Now, on the other side, if the deal is announced and you don't like the deal and the share price goes down, there is always the opportunity to redeem your shares for about $20. Unfortunately, with the shares currently trading at around $29 or so, this makes around a 50% max downside if you choose to redeem. But some of that downside will be offset by the value of the warrants that you'll be able to sell within a few weeks of the deal closing. Okay, now I know that was all very technical, but look, it's just a special situation investment, one that might offer great risk reward. The best SPAC on the market, in my opinion, is clearly the Pershing Square SPAC. For me personally, I want it closer to that $20 mark. The closer we can get to $20, the lower the risk. At even $22, I would be getting very interested. That would be a 10% downside and significantly higher upside potential. Look, I'm recording this in early March and it's nearly $30. If I had studied the SPAC earlier, I might have invested when the price was lower. Just at $30, my downside risk is now 50%, and I think that's pretty significant. Seth Klarman, the author of Margin of Safety and famous fund manager of Brokerage Group, one of the better performing managers of the last 30 years, has taken a big stake in Bill Ackman's SPAC. Now, Seth is a very shrewd investor and someone that I admire. So this is another tick of approval. Now, I think Seth invested for the exact reasons I have outlined in this video. He gets $20 downside price before the deal closes. He gets warrants and potential bonus warrants after the announcement. There's no 20% cut from Ackman, unlike all the other SPACs. Bill Ackman's company has invested alongside the public. Therefore, they're highly incentivized to find a great investment. And number 5, I like Bill Ackman's understanding of businesses. He is a follower of Buffett's principles, and although has made mistakes in the past, his character isn't in question here at all. If I was to get under $22, do I think Pershing Square Tontine Holdings is a good investment? Now, don't forget to subscribe so you don't miss any of my future videos. Hit me up in the comments as well if you have an opinion about SPACs or maybe a proven company that has big upside potential. And obviously you'll need to investigate a lot further if you want to invest yourself, but this hopefully has got you started. And a big thank you for staying to the end of the video, and I'll see you next time.